Unfortunately, Mike will no longer be joining us on our FIT discussions. Mike passed away September 7th, 2020, and we'd like to take a moment just to recognize how an important person he was to our daily lives here at AVC. We'll all miss him, and I'm sure all of his clients and friends will too. Good morning, everybody. Good evening. Today we're going to talk mainly about the U.S. markets.
Yeah, I think there's a lot to talk about. We've seen high volatility in the last 7 trading sessions, or 6 trading sessions if you're outside inside the US, because you had a Labor Day holiday on Monday. But basically, so I've got the one negative and the 2 positive charts, and then we'll discuss what we see in them. So the first thing is this 52-week highs versus 52-week lows, and you can see over the last couple of months, 2.5 months or so, lots of big green bars there showing lots of 52-week highs and not many red figures. And then this week you had a much smaller green bar, so only 19 companies hit their 52-week highs, and you're starting to see more companies hitting 52-week lows. So that's a warning signal, I think. We'll come back to that. But these 2 graphs show, I think, positive things. Here is retail money market funds are elevated. So you've still got a huge amount of cash ready to be injected and ready to be put to work back into the stock market. It's coming a little bit off over the last, peak was May. So it's a little bit down. So there's still a lot of money that's wary about putting money back into the stock market. Of course, they've missed a huge run up in S&P, but especially in NASDAQ. But still, there's a lot of money that wants to go back into the markets, and they're sitting in cash right now because they're very wary of what's going on. Certainly compared to 1 year ago, although that was, there was already people worrying about the future economy and the stock market performance even at the end of last year, before coronavirus really raised its head. This is another final graph for me, is another positive, is global capital goods shock surprises index. And you can see just from midsummer, basically, or end of the second quarter, when it hit its nadir, you've really bounced back very strongly. This is shocks versus surprises. So surprises are positive, shocks are negative. So we see there a big spike that is very positive for visibility. The big problem was there was no visibility. Everything shut down, everything stopped. So there was very little idea of what companies are going to produce in terms of results. And so common sense really that you've seen a lot of positive surprises, simply because nobody really knew what was going on, and the world was going to end, or we were all going to die from coronavirus, whatever. And now we're seeing very positive metrics, figures coming out. So we're seeing a big, seems to be a positive index, a positive indicator. I don't know where that's going to continue to, because it can't really go much higher, I'm guessing. Probably only down, but I think it shows a recovery.
Mm-hmm. Yeah, I think some of those, at least the last 2 positive graphs, kind of show that if there's going to be a pullback in the market here in September and October, it might not be to the depths we saw in March, but it might be, as we talked about before, probably a lot shallower. Ron, do you want to talk now about some of the stuff that you've been reading about the S&P until the end of the year, and how some of these positive indicators that Alan's have may feed into a later a run up at the end of the year?
So I just want to talk about what do we expect next for the stock market. And Barron's came out with the article today where they interviewed like a dozen of Wall Street strategists about the predictions for 2020 and 2021. And as you can see, for 2020 in this graph, the volatility is the 2020's big winner, and crude oil is the big loser, the biggest loser. And of course, tech stocks are good, gold are good, and what do we expect next? That was the main questions from Barron. And I'm gonna bring a different slide. So most of the Wall Street strategists that Barron's interviewed, they do not see the S&P 500 ending the year very far from the current levels. And the strategist's average year-end S&P 500 target is about 3490, and that is less than 5% above Friday's close. And still, though there are tons of risks to the market, and starting with the economic outlook, since bottoming in April, many economic indicators have rebounded sharp, but we also still see that the Main Street recovery has lagged behind the Wall Street. And we also see that investors looking to bet on a cyclical recovery might be better overseas than in the United States, where the valuations are much cheaper, like in Europe, Japan, and emerging markets. And we talked about it during our last feed. And currently low rates also should keep supporting the stock market, and most portfolio managers and individual investors either move money out of bonds and into stocks, or allocate new money to stocks rather than to bonds. So, and that what the Wall Street strategists think that would support S&P 500 current level, or a little bit of growth. And that also would support continued growth stock leadership.
So I want to go through and show some the indicators, not necessarily the economic indicators, but the technical indicators of the market right now, so we kind of know where we are. We've had a lot of, I mean, Alan, you've been handling a lot of calls from clients this week, thinking either is it time to get in? There are, it's the same kind of questions always, but I think there's a more heated discussion now that there might be a bottom in soon, and that we can expect rebound in the market, and people are looking at what sectors might be interesting to allocate money to. Should we go back into the tech-heavy leadership, or should we go back and wait for another leadership sector to evolve? So I want to take a look at some of that stuff.
That's basically what clients have been asking me this week. Is that we've had 7 pretty heavy sessions of maybe one up session in that 7. So are we near a short-term bottom? Is this turning into a trend, downward trend? Is this the beginning of a bear market, or at least a substantial correction? Is this a time to sell and get exit positions? And the losses are already there, but is it better to crystallize those profits that we've got and lock them in, or wait and then the market goes down, or is the market going to recover to a certain extent and provide another selling opportunity at some point in the future, near future?
So we usually look at McMillan's charts, and he had a sell signal here right at the top. That sell signal is still in place. Actually, he according to his rules, said the sell signal was a bit early. Of course, more closely look at is this equity put call ratio, which is beginning to trend up, and this one more significantly, you can see the trending up, which is on a sell signal now. However, the VIX did spike, and it came down again more than 3 points, which means it's on a buy signal. So we're getting mixed signals. However, the stronger, more long-term ones are on sell signals. And as we're in September, and we posted on our blog recently, we can expect more bearish days in the following next week. So starting from the week of the 21st to the 30th, these are really bad days for the market in general. So even if we get a rebound next week, we can see that, potentially things will sell off again towards the end of the month, which could set up for a good October, November entry, which we've talked about, and we'll be posting information on the blog. But right now, the market is suffering, and I just want to bring up the IBD classifies it as uptrend under pressure here, with 5 distribution days on the S&P and 3 on the NASDAQ. That means it's not in a full-blown correction yet, according to the IBD, but it is under pressure. Will it get worse? So if you look at, if you go back here and you look at these, yes, it can get much worse, and it can get much worse rather quickly because things start shooting, these put call equity ratios start shooting up aggressively when people begin panicking. Right now, there's no panic in the market, even though the NASDAQ was down at one time more than 10% from its all-time high. It really, we're still in this high level of complacency in a bull market. So where could things go, and how could things get worse? Well, let's look at some of these indicators. Alan, you highlighted earlier the U.S. high lows index here, and you can see that the high low index is rolling over as you showed in your weekly chart or histogram at the beginning. And until this rolls back over and we see some new highs being made, or more, or at least a flattening of this, then we can continue to see that the market will be under pressure. And of course, we don't expect maybe this complete fallout where everything is making new lows, because the new lows made in the lows made in March probably won't be revisited, but there'll be more consistent lows in some of these weaker sectors like the hospitality, maybe potentially airlines. So I wanted to bring up what did work last week, and that was materials sector, which is basically led by some big, like the Dow company and Newmont Mining. So there's chemicals and mining companies, but those are the companies that did receive inflows of capital last week, and showed some resilience, whereas energy really got blown out, and of course technology was the second worst performing sector. I wanted to go through kind of what we're looking at and just see if there's a chance for a rebound soon. Yes, these are in oversold areas already. The NYMO's in oversold areas. The NYSE hasn't even thought about rebounding a little bit here, so that's the accumulation of the NYMO index, and we need the NYMO to start posting positive gains for for the NYSE to turn around and go positive. It's early for that yet. The number of stocks above their 50-day moving average is declining. The put call ratios are accelerating to the north here, so we can expect more volatility in the market. And an early kind of warning indicator that we watch is when the number of stocks below their 20-day moving average reaches, or of the high levels, or let's put it as the chart shows it, the percentage of stocks above their 20-day moving averages is very low. We would expect some kind of a rebound, and it's getting low. A low number here would be below 20%. So if 80% stocks are trading below their 20-day moving average, then things are getting kind of oversold. So again, we may not see the kind of big fallout we saw in March, but until we get some clear buying signals, it's a little early to get back into the market, we believe. So that's what I want to leave it at today. We'll talk next week.
Thanks,
Okay.
Chris. Thanks, Veronica.
Yeah. All right. Thanks, guys.